We welcome in Ed Siddell, CEO, Chief Investment Advisor at EGSI Financial. Thanks so much for being with us, Ed. How have you been feeling about the market action?
Honestly, we believe right now is a great time for investors to be fully invested. We really like what's going on, even with the bond issues and yields going much higher today. We think that that's really just part of the fear index, and that's going to be short term. So we're really not concerned with that at all.
Yeah, part of my conversation with Michael Silos, who I was just speaking to from Alma Bank, was about the inversion of the yield curve, right? And that obviously made people nervous about recession and stuff. And now that it's uninverted and is back to a more normalized level, he said banks, are doing well. You make money that way. It brings a sense of relief ultimately. And, people that I speak with are buying on the pullbacks. I'm not really hearing folks as nervous at this moment.
Well, I think that has a lot to do with people realize the economy is growing. When you look at SBA loans for just manufacturing, they're up over 70%. We have nearly 10 trillion of new assets and investments pledged to the U.S. economy over the next couple of years. Employment numbers, they look healthy. Earnings are up. Inflation growth is coming down. So big picture from hard economic data, people look at it and they really like what's going on. And that's why when you saw Moodys downgrade on Monday, really investors shook it off after a couple hours because they see bigger picture.
Yeah, earnings have been pretty decent when you look back at the current quarter, though some are giving wider ranges for the outlook or withdrawing guidance because they have some uncertainty. What do you make of that?
Honestly, I believe that they're kind of hedging their bets just to make sure that expectations, really what they're doing is setting expectations for the next quarter's earnings so that people aren't anticipating higher earnings just in case they're not there and make sure that their stocks remain strong. But for us, what we're seeing is with the tariffs, we'll know at the end of 90 days. But really with the reconciliation bill coming through, we think that that's going to pass. We know that the SALT issue is a big hangup, but they are going to pass it. There's a lot of things in the bill that we don't like as it relates to additional spending. However, big picture, it does have to get passed in order for these current tax cuts to remain in place. And I think once that happens, that's going to alleviate a lot of uncertainty in the market, and we're just going to continue to see the economy grow.
As Chief Investment Advisor, what's your advice to folks as far as strategy for investing here?
Well, we are almost all in. We're about 90% into the market right now. We're still looking for really good buys. Honestly, we really like industrials. We like the tech sector as well. When you look at the 50-day moving average, just in those two sectors, 90% of the stocks are above their 50-day moving average. So that's an indication that we're at or in a bull market. I also like financials. There's some really good buys in financials. And again, once this reconciliation bill gets passed, we're going to start moving into deregulation, and that's really going to help the financial sector as well. But as far as individual stocks go, again, the tech sector, I like Celestica. It is up over 24% this year. It's a very strong company. They have a good, strong balance sheet. And the same thing with the API group. Again, that is really good indicator. They've got great earnings, but an indicator of where the economy is going. With their orders up, I think that that's a really strong indicator of growth, not just in the markets, the economy, but for themselves. They're up over 30% year to date as well.
In the meantime, what about the Mag 7? Do people ask you about that, and what do you tell them?
Believe it or not, we like it. The whole tech sector, all the way across the board. Again, these are very strong companies with strong balance sheets. They're resilient. Even if we look at something as simple as Tesla, as soon as Musk went back to Tesla and left Doge, really Tesla really turned around. Again, strong balance sheet, even though they said short-term orders were down. We believe the whole Mag 7 is really going to be strong through the end of the year. We also believe Google is very undervalued right now.
Really? That's actually really interesting. We were just showing some of the trades in options corner that people are making on Alphabet right now. As far as Washington, the reconciliation bill, what does that mean? We talked a little bit about it right at the top there. But, as far as the action we're seeing on Washington pertaining to that bill, also July 9th is when these tariffs, I don't know, the 90 days are up. Then what?
Well, right now, the administration said that they have 20 deals that they're getting ready to announce. So hopefully they start to announce it in the next week before Memorial Day. We do have a feeling that they're going to extend part of the 90 days. No matter what, we don't think the tariffs are going to go completely away. We think that we're going to see a flat rate all the way across the board for those that we're negotiating with of 10%, maybe 15%. But when we look at prices, people are looking at that and saying, well, we're going to see a price increase. But we have to look at the inverse relationship to energy costs, because we're seeing energy costs come down, oil costs come down. And again, we are a petroleum-based society, and that energy, getting things to and from the ports, to and from the stores at a lower cost, again, that's going to be the trade-off against the tariffs. So again, we're not that concerned long term.
Right, understood. And last but not least, I mean, the Fed, would it be a big deal if the Fed threw in a couple of cuts? I'm not saying one way or the other what they should or shouldn't do. Would that help, or is it more about fiscal policy now?
It is about fiscal policy, but believe it or not, we think the Feds should cut. We think that they're late to the game, just like they were when they should have been raising rates, and they were saying that inflation is transitory. They're so focused on the jobs numbers. If they actually looked at the hard data, the economic data, we believe that they should lower rates starting in June, and we should see a minimum of two rate lowerings this year. I don't know if we'll see it, but I think if things continue on the way that they are, they will. And again, that's going to help the economy as well.
Right, understood. It's good to see you, Ed Siddell, CEO, Chief
Thanks for having
Investment
me.
Advisor, EGSI Financial. Thanks, Ed.